if you were looking at the markets since my last little video here yesterday, talking about the Bitcoin and crypto market, you'll notice I told you there were intersects of the power means and the RMLRs on the weekly and daily and lower time frames, and that we were well within multiple zones to expect a relatively nice move, right, relative to the time frame on the weekly and on the daily, and also on lower time frames. Well, if you look at Bitcoin, if you look at Solana, if you look at other, other coins across the crypto market, even meme coins, you'll see they went up significantly today, and had very nice moves to the upside, very nice distributions to the upside. Why? Well, because there were intersects of the RMLRs and the power means, and look at the volatility across those different time frames. They were also set to move the asset to the upside, and they did. Was there a probability that the assets could have dipped a little bit further? Absolutely, there's always probabilities. There's also a probability they could have just gone sideways for a while, but they went to the upside, which was the most probable thing that would happen. We even told you about it on Monday during the live stream, and on Saturday during the live stream, we said look for the assets to be set up for a very nice week of scalps. It's getting set up to be a heck of a week. We could have a very nice week to the upside. So far, we've had that. Today, you'll notice that the VRE widths of different assets are much wider than yesterday because of what the assets managed to do in the last, in the latter part of the day, towards the end of the day. So now the VRE widths on a lot of the assets are much wider. Yesterday they were pretty tight, which was indicative that there would be a trending day. So there'll probably be on some assets a ranging day today. We'll see, especially on like memes, coins, and on some altcoins that had pretty significant moves to the upside, especially towards the end of the day. So that we're stretching out their VRE widths pretty significantly, and take profits early and often, limit your loss. Don't be emotionally attached to your trades, right? Remember, if you miss a move, you can always get on the next one. It's not worth chasing a move. If you see if you're trading the daily candle, well, you missed yesterday's move, and today it's already moved a little bit. If you're trading such a high time frame, good luck, because there's not going to be that many moves. But if you're trading low time frames, then you'll look all the way down to the 15-minute and lower, and you'll see that even on the 15-minute, even yesterday, there were plenty of opportunities to actually get in on quick downside trades, relatively quick downside trades, and on more long-term, higher trades to the upside. Now, I say quick, even though 15 minutes is really not quick, but it's an intraday time frame that you can certainly trade. But just be careful, because when the monster is running hot to one side or the other, you don't want, for example, at the moment, if the market is going up generally, you want to be real careful about running shorts. Doesn't mean you can't run shorts. In fact, it's a great time to be running shorts, but you want to be careful, super careful, to monitor them correctly, because shorts in an up market, can drop either, they can drop slowly or quickly, but then turn around sometimes very fast. And it might just take away your profits in an instant. So you want to make sure that you get out of your trades quickly, taking profits if you're running shorts in a market where there's seemingly a lot of buy pressure. And likewise, if it's in the other direction, right? Like longs in a market where there's a lot of sell pressure, you got to be real careful and not get wrecked, because all of a sudden it turns around and starts dropping, right? And then market changes, every day. Whether there's sell pressure or buy pressure, changes every day. which one is more. There's always sell pressure and buy pressure. The question is which one is more dominant at any given time. So at the moment, there has been quite a lot of buy pressure on like the daily and the 4-hour time frames in the past couple of days, and it certainly looks set to continue doing that, big picture. But that doesn't mean that every day is going to be an update. For example, there could certainly be some very mild or not so mild pullbacks today, right? Like there are mean reversions happening on the 4-hour Bitcoin to the 3012 RMLR. The last time I looked, it had not completed that yet. If it had, the asset would have dumped down to around 85 or 86K, right? And I didn't see that happen last night or this morning. I was, the last I looked at the chart, I didn't really get to focus on it because it was like I got woken up rudely at like 4 a.m. by the sound of a siren. I don't really want to get into that, but yeah, we had another attack here in northern Israel, this time from the Houthis in Yemen, apparently. Fortunately, no one was injured or anything, but it was a rude awakening, and got to go to the bomb shelter and all that at 4 in the morning, and all that stuff. Anyway, ridiculous nonsense. But yeah, so Bitcoin and alts have been moving up nicely so far this week, as expected, because again, there was an intersect of the various RMLRs and like the 30 power mean on smoothing like 10, right? It had been running into a bunch of different RMLRs on a bunch of different time frames. So of course it was setting up moves, and they happened. Very often they happen on the 0 candle, or they can also happen on the 1, 2, 3, or 4 candle. It's perfectly normal. Now, doesn't mean you'll always get the biggest moves when there's an intersect, no. But you will get a move that's relatively nice relative to the time frame. You can get plenty of moves that are even much bigger when there isn't an intersect or a period of time following an intersect. There's plenty of moves that are happening on a particular time frame that don't appear to be connected to an intersect. But I bet you, if you look at another time frame, right, you will see an intersect there that happened that kicked it off. Now, why is that? Well, that's because when you have an intersect of a power mean, which is the mean of returns, it's one of the means of returns, and a reverse mean of log returns. When you're having an intersect there, well, you're very often having a situation where volatility is basically set to either expand massively, and the correlation is also set to move massively, or you're saying the volatility is set to contract massively, and the correlation is also set to do something massive, right? Either expand or contract significantly, right? When that happens, is obviously going to be a big move. It just so happens that when there's an intersect, it's not always the case, but it's pretty often the case, right? And when you have an intersect happening on multiple time frames, from like the weekly on down to the intraday time frames, all happening around the same time, with volatility lining up in the same kind of way, you're typically going to have a move that's going to be pretty staggering. So, I mean, for example, like I was looking at Bonk, which is a meme coin, Solana meme coin yesterday. It went up like 23% yesterday. 23%. Like, you don't need leverage for that, obviously. On any random day, that thing will move a few points easily. And if you're trading it intraday, I mean, you can easily stack up 10% in a day on a coin like that, which is crazy, right? But if you trade it intraday and it goes up and down 5 points and it ends the day flat, you're still going to make 10 points on an asset that essentially didn't move on the daily candle. But intraday, it moved like 10 points. And it can move back and forth, back and forth, back and forth a few times to do that. Yesterday, it pretty much just went up, starting about, I don't know, 6 hours, I think, after the beginning of the day, daily candle, it just went up, and it went up like 23 points or something crazy by the end of the day. Maybe even more, I don't know, whatever. It was up a lot. And then it started today, and from the low to the high that I saw recently, about an hour ago, it actually went up like more than 7% or something crazy today already. Like during the first few hours of the day. It's nuts. And those are meme coins. Yeah, that's a meme coin. Like plenty of meme coins move crazy like that. But that's why you got to be real careful when you trade those things, because you might expect that an asset moving such a high amount in a day is going to not just distribute during the day, but it's also going to mean revert like crazy during the day. Well, if you thought that trading bonk yesterday, and you might have been waiting for the short, maybe you were just waiting for the short to take a quick short after massive distributions to the upside, or maybe you were waiting for the short, not even to trade the short, but just to get a better entry on an upside, on the next upside move. You might have missed those moves, because if you weren't looking at your screen for 5, 10, 20 minutes at a time, you easily could have missed those moves, right? So you got to actually be looking at your screen, or have your alerts set, but you got to know what to look for with your alerts, and that's not always the easiest thing to do. So you got to look for what to look for, basically, which means you got to look at your screen during your trading session and actually be engaged with it. Because if you miss a day where you missed 23% upside gains, it's not like you can't make 23% upside gains on another day, but when it's basically in one direction and you have indicators saying you can just stay in this trade the whole freaking day, as long as you're carefully monitoring it, right? Like if you were trading based on the ALR and the AVQ on the 15-minute yesterday, like on the free volatility chart, you could have stayed in that trade all day. All day. Now, would you have maximized your profit by doing that? No, probably not. Like if you're trading faster than that, you could easily have made much more than 23%, because there were a bunch of little candles that did go to the downside, even on the 15-minute. Right? So you could have made an additional, number of percentage points during the day. But if you were sitting there and being like, you know what, I'm just going to ride this thing out on the 15-minute, let's see how it goes, especially after you get into a trade and it's going so well in the first 15 minutes, you're like, oh, hell, I'm just going to stay in this thing. And then the next 15 minutes goes really well, and the next one goes really well. By the time you start seeing a pullback, if you didn't take your profit and then it bounced again, you might tell yourself, oh, I'm just going to stay in this trade now that I've locked in, my profits. I've locked in my whatever amount that I put in the trade. Now the rest is all gravy no matter what happens. Right? Okay, well then at that point, really, you could have stayed in that trade the whole day and you would have made sick gains, 23%. And yeah, you wouldn't have optimized the trade, but you would have pulled in an insane amount for a day of basically watching a pixel move up a screen. And there were a lot of assets you could have done that with yesterday. Right? That's why when you're trading, it's important to be trading, to be looking at your screen on days like that. And the thing is, you're not going to know when there's days like that happening until they're happening. Right? Yes, we told you there was a probability it might happen. But if it didn't happen yesterday, maybe it would have been happening today. Maybe yesterday's crazy day would have been today, but it turned out to be yesterday. So if you weren't looking yesterday, you missed a very important day. And it happens. That's life. Right? But that's why you often hear statistics quote things like, oh, if you missed the 10 most important days of the year, then you missed the whatever 80% of the upside or whatever. Yeah, okay, that's not really for intraday traders though. That's for lazy traders or retail investors who are looking for like shortcuts to finding a magic path to success and wealth and all that stuff. And there isn't. You got to make it. And the way you make it is to be in the market. And when they say, no, nobody can time the markets, that's just not true. Right? If you're actively trading in the markets every day and you have a sense of what's going on, well, your longs and your shorts are literally you timing the market. Right? And when you do that, whether you're right or wrong, that's what you're doing. Right? And how can you make sure that you're actually right? Well, you can use the right calculators and use the right trading strategy or method. And that starts with being able to read the information from the calculators correctly and being able to take the appropriate action, which is, again, you gotta have good risk management, right? That's the most important thing. More than any calculators, more than anything else. If you don't have good risk management, you're not going to be a good trader. You need to have good risk management. That's the most important thing, no exception. By far the most important thing in trading, good risk management. You got to know what you can put on the table as risk and what you can't. And you got to be humble about it and grow. You got to be willing to accept to grow relatively slowly to your overall stack size. That way you can grow continuously, consistently, profitably, without these wild swings and risks. And then, of course, the 3 basic rules, which are really part of risk management, or they're an extension of risk management, but they are spelled out very clearly so that you don't mess them up, which is take profits early and often, limit your loss. So when you're in a bad trade, just get out. Just get out. I don't care if it's you're wrong for a moment. You're wrong for part of a 30-second candle or a minute candle. I don't care. As soon as it starts going against you, you just get out. And then you can wait a minute or 3 minutes depending on your position size and your comfort level and your risk appetite and all that stuff. But when you're wrong about a trade, you should get out as quickly as possible. And you should not accept waiting around for however long you think it shows that you're not showing anybody that you're tough by losing more money. You're just losing more money. So limit your loss, right? That's the second rule. And the third rule is don't be emotionally attached to your trades, right? Don't trade things that while you're trading them, you care about them emotionally. You shouldn't, right? You're just trading them. Now, I don't care if you like that thing or even love it outside of your trades, but you got to be able to compartmentalize the thing outside your trade and the thing when you're trading it. There's a big difference. Like if you care about, I don't know what, Solana, okay? Or you care about Bitcoin or whatever. You really love these things. Well, when you're trading them, you better not. They're just numbers. They're just numbers. Don't think of them as coins. Don't think of them as crypto. You're not trading that aspect of them. You're not trading their ability to be uncensorable or divisible or portable or make NFTs on them cheaply or have, whatever. You're not thinking about any of those things when you're trading it. You're trading the volatility, the entropy, the probabilities, and the statistics. That's it. They're just numbers on a screen. It doesn't matter what they do. Right? If you feel you are emotionally attached to the things you're trading, stop. Get out of those trades. Don't trade those things. And go trade things you don't care about. Just go find some random thing you've never heard of that you don't care about. Don't even look up what it is or what it does. Just make sure it has the necessary liquidity, the necessary history to see some decent chart information, and good volatility and good entropy, right? If it's got all that, if you got good charts that show you good history, so it's not like, and it's nothing less than 4 years old at the bare minimum, right? Hopefully it's more than a decade old, so you can start to see some, higher time frame information. But certainly, grab something that's at least a few years old, 3 to 5 years old at least, so you have some kind of, good daily information, maybe 2-day information, maybe 3-day information. right? Then you can trade that thing and not have to worry about the fact that you care about it or not. Now, if you want to look it up and see what it is, you can, but make sure you don't get attached to it. Which is why I say don't even look it up. Just see that it has good volatility and entropy and good liquidity, right? And a good history. If it has sufficient history and sufficient volatility and entropy and sufficient liquidity on markets that are, that you can trade on safely, relatively, then it's good to trade. It doesn't matter what they do. Now, if all of a sudden you hear something terrible happen to that company because of bad management or whatever, that's a different story, right? You might want to avoid companies that are involved in scandals that are possibly going to immediately take them down forever. And there are occasions when the company is probably going to disappear. This does happen, right? When that happens, you just want to get out of the company. You don't want to be, you don't want to be trading that, obviously. But that's not most companies most of the time, obviously. That's what happens occasionally to some companies because of scandals or mismanagement or whatever. So if that happens to be the case on something you happen to be trading, well, then don't trade it. Very simply put, just don't trade it. Think about it that way. Right? Go ahead and hit the like and subscribe and comment and share and all that stuff on this video. That way you can tell the algorithms to share this with other people about trading, right? And if you do that, the algo gods will bless you forever. I promise. I know, I spoke to them. Actually, they speak to me. Wait, which one is the crazy one? If you talk to God, it's normal. If God talks back to you, then it's crazy, right? Yeah, okay. So, yeah, I spoke to them. To whom? To the algo gods. That's to whom. Maybe I'm joking, maybe not. You believe in the algo gods, don't you? What? You don't believe in the algo gods? But Google said they're real, didn't they? Someone said they're real on Google or YouTube. Keep hearing it from all these other YouTubers. So it must be real, right? I mean, if I saw it on YouTube, there was a time when people would believe whatever they saw on the TV. And yes, I said the TV. Because there was a time when some people would say the TV. I done watched it on the TV. We don't really live in those times anymore where people watch things on the TV. Most of what they watch now is on the YouTube or other internet video networks. Rumble, Vimeo. Do you watch videos on Vimeo? Comment in the video below, in the comment area. In the video below. Comment in the comments below if you ever watch videos on Vimeo. In fact, comment what is your favorite video network on the internet. Especially if it's not YouTube. I mean, even if it is YouTube, write it. But I'd love to know what other video platforms you guys watch, because I know what people generally watch. I know what networks people generally watch. It's not all Rumble or YouTube. There are other platforms that people can watch videos on, but do you know what they are? I wonder. Anyway, guys, that's gonna do it for now. It is Wednesday, so beware, David Peg. Remember the risk management and the rules. And go get them coins, go get them sats, go get them lights, them lamps, whatever you're stacking. Stack it well. Stack it often. Rinse and repeat. Keep your eye on the ball. Right? And just because, if you miss yesterday's trades, it's okay. I mean, sure, it sucks that you missed a massive day on whatever asset you might have been trading, but there's today. And we don't care about the direction. Remember, we're not in it to stay in a trade all day long. Right? We're in it to change the trades we're in constantly, to mix it up, right? What's the best way to do that? Well, short-term trades. So do that. Get yourself some short-term trades going. Low time frame volatility trades, in other words. And we'll see you in the Shark Tank, in the pit, in the wolf den, whatever you want to call it. And be sure, if you want to learn how to trade this way, you enter the volatility traders Discord known as Alpha Trading. Because that's what we do all day, right? We share charts, we talk about what the assets are doing, and answer questions for anybody that has any about how to trade this stuff. And the way you do that anyway, long story short, do that, right? Go to the Alpha Trading website and I'm sorry, the Alpha Trading Discord, actually, right? It is free to enter it, and we'll see you there. alphatradinghq.com/discord. And you can come in and get your free volatility starter pack, which will get you all the indicators and the free chart that you need to learn how to trade volatility, entropy, probabilities, and statistics. And it's really, just so we're clear, it's volatility, probabilities, and statistics that you'll learn, and for free. You can also learn how to trade entropy for free, but you won't have access to the entropy indicator on your own. You'll just be watching us posting charts about it, whether unprompted or you ask for a chart with the entropy indicator on it. Somebody might post a chart once in a while for you so you can see it. But the free tools don't include the entropy indicator because, first of all, it's an advanced indicator, and you got to learn the basics first before you can drive the advanced version of the indicators. Second of all, well, we got to keep a little something premium because it's really an advanced indicator, and we don't want to just give access to that to random people who just want to get free access to everything we have. It is so powerful that giving that away would frankly be foolish, right? Because you could trade the entropy indicator all day, and that would be enough. And just like you could trade the volatility indicator all day, and that would be enough. But if you've got both of those things completely for free, then you have no incentive to help out our amazing developers who do wonderful things for you and give you all this free tools and everything else. And, we like to reward them once in a while by giving them a little bit something back. We do that by getting some people to, people who subscribe, we contribute the share that goes to them. Like, our developers got to get paid too, and the people that put in all the time to make alpha trading, they also deserve a little bit of something for all the good effort they make. So anyway, that's going to do it for now, guys. Come see us in the Discord. Remember, the live streams start at 11 a.m. So hopefully we'll see you there. And yeah, that's going to do it for now. Okay. See you cats later. Happy trading. Peace.